Awesome. Well, John, I'm really excited to have you on. So for our listeners who don't know, John Mayfield is with us. John, let's kind of introduce yourself and kind of what you're doing these days.
Yeah, John Mayfield. I'm with Album Ventures. We're an early stage seed fund, primarily investing in the seed and A rounds of B2B SaaS companies, some marketplaces, and just generally, great entrepreneurs. We do a lot here in Utah, where I'm located. We also invest in the Mountain West, and we have companies ranging from California to Austin, Texas, to Florida, New York, and even this year we added one in London. So
Cool.
we're not focused internationally, but when we get introduced to great people and it fits our thesis, and it sometimes comes together like that. So yeah, we at this point we are in Fund 3. We have invested in about 80 companies at this point, and we will be rolling into Fund 4 within the next year. So pretty exciting. So I have a background, came out of college doing financial services consulting work. So worked at a firm called Duff and Phelps out in the Bay Area. They do M&A transaction work. When companies buy another company, we come in and do a lot of the kind of valuation work. We do some private company valuations, and then just portfolio stuff, valuation work. So basically just I lived in spreadsheets for a few years, came back to Utah, spent a little bit of time with another venture fund before joining Qualtrics back in 2012 when they raised their Series A from Sequoia and Excel. So I spent some time there at Qualtrics, met a lot of amazing people there who are still kind of some of my favorite people in my network today. We've actually backed a few of them, and a lot of them are now working within our portfolio or alongside us as investors. And so I was there for a while doing marketing and sales functions, and then Peak Ventures came around, and 2 years ago we transitioned over to Album. So
I'm curious, since we're already on that, let's just talk about some of those ones in Utah. We do want to kind of put a focus on, because we're in Utah as well, so it's kind of
yep.
cool. There's quite a few big ones that are in your portfolio here in Utah. Name a couple for us that's in there.
Yeah, so Fund 1, some of the better known names in Fund 1. Podium was one of our first investments, actually.
Wow.
We invested in them when they were fewer than 5 people, and now they've grown up to be.
That's a pretty good investment. If you don't know what Podium is, it's a pretty good sized company now.
It has done really well. They serve kind of Main Street businesses. They started out with review software, kind of soliciting reviews, but have really morphed into kind of an operating system for small businesses, Main Street businesses. So they have a large focus on auto dealerships and auto services, home services, medical, kind of retail offices. So yeah, so Podium, that's a great one. We love Eric and Dennis and all the people that are over there. Another one in Fund 1, we've got Weave, which is actually kind of has some overlap. They didn't at the time, but they were doing more phone systems at the time, but they've kind of built out a lot of their software. MX was an early investment. So we came into that one a little bit later than normal. They were not a seed company at the time. And then let's see what else. Degreed. Degreed has a Bay Area headquarters, but large presence in Utah. What else? Divvy. Divvy's done well. Route.
Divvy just sold for $2.5 billion. So there's a unicorn.
$2.5 billion. And I mean, if you check Bill.com stock, it's just done insanely well. So kudos to Blake and Alex and Sterling, Tyler, Blakely, all the great people over there. What else? I know I'm missing some. Filevine is good. Route, Neighbor, TaxBit this year has had just kind of broke onto the scene. So I'm not.
It's funny. Like there's so many big companies, right? That you're just casual. Like you forgot about Neighbor or like Route is just like he was like that's just crazy to me. Needless to say, for our listeners, like you guys have seen some huge success when it comes to building.
We've been really lucky, and there's many that I haven't mentioned that are coming up or doing amazingly well. So Utah has been very fruitful to us. The founding thesis of the firm was really there are so many great entrepreneurs in Utah. There have been great successes. There's not enough money at the early stage. So that was our founding thesis, and fortunately, it's been true. So we've been one of not very many sources of capital that are kind of consistently putting money to work at the early stage. So,
awesome.
we have caught a few of the great ones, and we're just grateful that, we've been along for the ride.
Yeah, I'm super excited just even a little bit later to kind of dive into why you think, raising rounds is so hard early. But before we do that, we just went through all of these awesome companies that you've had the opportunity to invest in. I'm kind of curious to hear the story of what your first investment looked like and how did that go?
As a seed fund, fund one, we actually did quite a few investments. We did 31 investments. Our loss ratio in that fund was actually really low for a seed fund. So we did hit some great companies. I didn't even mention Homey. I mean, Homey was one of our first ones too. It's done awesome. So I don't know exactly how to answer the question, but we did a high velocity of deals in the early days. Like we did about all those investments over the course of about 18 months, which is kind of crazy. So that was, almost a deal and 1.75 deals per month or something like that. So we were just doing a lot of deals.
Just turning them
at that point, our checks were quite a bit smaller. Our first check was kind of $250K to $500K. Now we're average check is about $1.5 million, just because we've grown and the seed market has kind of matured quite a bit. Mm-hmm. And so, our first checks we have a heavy focus on the diligence of the people. So we spend a lot of time with the founders. We do a lot of back channeling. Hopefully they do a lot of back channeling on us. And I think that's been one of the secrets to our success is just, we do spend a lot of time with the founders. We are founder friendly. We don't jerk people around. We answer emails. Sometimes we ghost people accidentally, but, just really standard, easy stuff that, you think is just kind of table stakes. Like we just kind of show up. So, and then just a lot of
answer the phone, right?
Like just exactly. That answer the phone, answer the email, answer the text, go to the meeting, do the work. So, we did put in a lot of time and cycles in that first fund. We still work hard, but now we have a little bit more of a reputation, and I would say the inbound referrals are much stronger than they used to be.
Yeah. So I'm kind of curious. So a lot of our founders are really early in their idea. I would say pre-product.
Yeah.
What type of advice do you have for those people who are obviously looking to raise a fund or things like that just before they have a real product? What advice do you have for those?
So we kind of classify entrepreneurs in two buckets. There's many buckets you could, but you can usually split them into two buckets. It's like you got the mercenaries and the missionaries. And this has nothing to do with religion, by the way. This is, the mercenaries are the types that it's very profit motivated and very kind of short-term get rich quick motivated. I'm going to make this I'm going to make this company and hopefully it gets sold in a year or two and I make a few $1 million. There's not a problem with that, but I don't think the best companies are generally founded that way. There are exceptions. We try to target those who are missionaries, who it is kind of part of their life mission, or they've had an itch that they've wanted to scratch for years, or they've explored some aspect of a market for so long and they just really understand the way that they want to go at it. So the reason I bring all that up is because I think the missionary types, they will find a way. They will find a co-founder. It doesn't matter how long it takes. They will learn how to code themselves. They will scrape together whatever funds necessary, even at their own peril, they'll do it. And so I think that's kind of, starting through that lens. I think it's important to understand kind of how you're approaching the problem and kind of where you fall if you're starting a company. And I think, I would say building a product, sometimes we see entrepreneurs come in with these huge grand plans. They want to do something to boil the world. They want to have a Salesforce level app in 3 months. Look, it's not possible. Earlier in the conversation, I mentioned Podium, phenomenal company. I think they are the poster child for what you're getting at here. So Eric and Dennis, they kind of taught themselves to code and they put together some of the early versions. Same with Neighbor. One of the co-founders over there, Colton, not an engineer by trade. He was their first kind of CTO. Wasn't that technical, but put together a first kind of, pass at the site that was, break all the time, didn't really work that well. But hey, look, it's showing we're making progress. And I think you can start really, really small. People like to talk about TAM and like how big is the market size and all that kind of stuff, I would actually challenge most people to say, try to find something very small, actually. Try to find something that you are, even a very simple app is the most important app for that small group of people, because you can always build more product and you can always expand your vision. So the problem is sometimes you just overbuild and you build kind of an okay thing for nobody. So that'd probably be my advice to people. Like, I think start small and start extremely focused and be very important or critically important to a very small group of people.
So I want to really like narrow in on that, because starting small, I feel like can mean a lot of things, especially going back to the comment you made earlier. Pre-seed round checks are getting larger because people are like that market's starting to mature. And at the same time, I'm wondering if that's also correlated with basically the demand or the quality of product required for customers actually engage and like use it and pay for it. And so when you say start out small, what do you mean by that? Because when you brought up Podium, I'm guessing like there were pieces that didn't work.
Yeah.
If somebody were to present something to you that wasn't fully functional, like how do you define functional? What do you hope to see?
Yeah, that's a great question. So I think it's highly dependent on whichever market you're serving. I'll just start off with that. But I would say when I say start small, it doesn't mean it has to be like overly simple or doesn't work. It means do something very, very focused. So if you're going to build a reviews app, I don't advise that right now, by the way, but I would say it's a form that asks for feedback. And if you do this, then it does that. If you do that, then it does this. It's just super simple. And like it can be built robust, but you can always build on the product. But like get that first kind of proof of concept up there first. I do see people like spend a lot of time building in like a dark room, and the customers they have no idea if the customer is going to like it, and then they release it and they just can't sell it. And so, I think there's like a customer discovery that should happen pre-product, but then once you know what the customer wants, like build just that. Don't build like these gargantuan kind of monolithic apps. So I do think it's getting easier. There's a lot of dev shops. There's a lot of ways to learn coding. There's a lot of like libraries you can leverage. There's other apps. Like I've seen people kind of do V1 with like an Airbase backend database. I mean, you can do things like that early on just to prove that there's demand for the product. And I think it's easier in SaaS. Like I'm not saying this is wide sweeping advice for every type of company, but I think like there's some particular types of applications where you can do this. But yeah, I think that's what I mean by that is just start focused. Like you kind of got to know what you're doing, and that comes from like informed take from either your own experience or from, speaking with a lot of customers.
Yeah, I agree with that completely. Like I say that one thing that we try and really drive home with everyone we talk to is be hyper focused, like with what you're building.
Yeah.
A lot of people come to us and are like, hey, we want to have 5 major features around social, chat, connections, like
Maps.
all of this stuff. Yeah, just this thing that would take 2 or 3 years to develop, like at scale to work really well, right? When like you're originally coming into this to solve one specific problem, and like you just need to do that. Don't focus on everything else. And that's something that we push all of our founders to do. And so I really love that you mentioned that.
Yeah.
I'm kind of curious, what is the best way to either get in front of you or to get in front of another funding team?
Yeah, I think just being remarkable is one thing. Like showing excellence somewhere kind of helps you stand out. That doesn't like necessarily get you in touch with us, but like those people who are doing interesting stuff on the nights and weekends and doing cool stuff, like they have a lot to talk about, and they usually are collaborating like with interesting people, and those interesting people sometimes know interesting people. Anyway, I would say
networking is pretty important as well.
Networking. So it's just like getting involved with like interesting meetup groups, stuff like that. I would say that kind of that's like the step 1 or step 0. I would say though, to get like, if you just want to go direct to the source and like capital, you can go on Crunchbase. You can kind of see who's invested in what companies, like what companies are not competitive to you, but like, hey, we're B2B SaaS, you're B2B SaaS. It's like, if we've backed that person, go try to meet that founder, go meet someone on their team more than likely they will know Album or they will know XYZ investor. So I think that's the best way to get introduced is like through a portfolio company, because those are the types of warm leads where we're like, oh, that person sent us. Okay, yeah, I'm right on that. I want to meet them. And then I'm like calling that founder and saying, hey, how was your conversation with them? What do you think? I would say that's the absolute best way. There's also like, your standard run of the mill events. We go to a lot of events and like angel investors do too. I would say that's a pretty good way, just kind of emotionally intelligent, intellectually honest way approach people. Don't like go in for the kill and the close like on the first meeting, but like, just be an interesting conversation with people. And you can meet people at events.
Ask for advice, right? Usually those advice.
Yeah. There's the old adage, and then I think like, it's not like the best way, but I would say like people are on LinkedIn, people are on Twitter, people are on all these platforms, like do something interesting, like share interesting stuff, do a cool, blog post or something. Those are the types of things that get you noticed where people are like, oh, that's an intriguing person, interesting thoughts. They really know a lot about that market. Like that, I would say that stuff does get noticed and shared on the platform. So
John, you're telling me that we can't just go to the website and submit a pitch deck to you, or is that
actually you can?
Okay, and tell me, and that's why there's a difference, right? Like, that's what's going to be more successful.
It's all about the odds. So funny enough that you mentioned that, we are doing a deal right now. I think it's happened twice in 80 investments. We are doing a cold outreach deal right now. So it does happen. It does happen. The odds are lower, but we do monitor ours.
Can't speak for everybody.
I can't speak for everyone, but we read every email that comes to that box. We spend 3 minutes on each. Like it's not like a lot of time we spend on each of them, but it happens, and we're super excited about the deal. It happened to be a quite competitive deal too. Like there were a lot of people that liked it. I think the entrepreneur just kind of decided to blast everybody. So, it does work, but it's like sub 1% odds. It's really low.
Tell us a little bit about like what you saw that piqued your interest. I assume it was a little more than the subject line, and I assumed it was a little more than like the revenue numbers.
Right. Yeah, it totally was. Yeah. I think there was a lot it was thoughtful. The entrepreneur happens to be in a very interesting space, e-commerce tools, where, e-commerce is exploding. The founder had like an interesting background too. Like, so, and then we just hit it off with the founder, when we did meet in person. So, this entrepreneur had actually worked at competitive companies to, I think, 2 or 3 of our portfolio companies. So it was kind of just an interesting juxtaposition, like, oh, he had experiences, we had experiences. And it was kind of, so, it was kind of a little bit of serendipity, but, there was just kind of, he was a very prepared entrepreneur, if that makes sense. Like, he'd just done a lot of stuff and had met a lot of people, had worked on really interesting projects. That was kind of going back to like, get involved, you meet people and you have connections and it's like, oh, Bodger, you know him? Oh, cool. Okay. You know her? That's awesome. Like, you know what I mean? Like you build rapport and it just kind of helps the conversation get off on the right foot.
The fact that you got a cold outreach seemed lucky. That's the best way I could put it.
Yeah.
Just like everything kind of just fell in serendipity, everything clicked.
Yeah.
Whereas like if someone were to come to you, one of your portfolio companies, be like, hey, I got this person that I'm actually connected with. They have a really interesting idea. Would you hear them out? The likelihood of that is going to be much better.
It's much higher. So the info box, the whatever box, it's like sub 1%. An intro from a founder is probably 10 to 30%. You know what I mean? It's like, it's much higher. Like, unfortunately, we would love to do more companies. We just can't and don't.
Well, here's the third. How many submissions do you get a week, a day, a month?
I don't know. We probably see over the course of a year, I don't know, maybe 1,000. It's maybe more, but like, we get a ton of just random outreach, but we don't really respond to those, so we don't count those. But probably 1,000.
So I'm curious, John, are you the one that actually goes to lunch? So hey, the founder of Podium was like, hey, this company looks really interesting. Would love to have you meet them. Are you one going to lunch, or do you have, what's the process like? Do you just go and meet them, or?
At our firm, I can speak for us. We're really small. We do not have a big staff. We do that kind of by design because we think at the stage we invest, it's really hard to throw like, a brand new grad at a founder and say, hey, you just graduated from University of Utah, go meet with this person and tell us, if they have the right motivation, if they're a missionary, if they are, if what they've done that's interesting, those types of people, like I was one myself at one point. Like you're very good at analyzing numbers. You're good at kind of taking a task. You're not good at like reading all of like the, connecting all the dots. So I would say that's kind of our skill set here at Album is we can connect the dots. We can kind of see the trajectory, we can kind of read a person and see what their true motivations are. And if they're, the type of person that we think that would, we could work well with. So that's a big part too.
Would you say that's because it kind of leading in my next question is like, what type of things do people need to have prepared, right? Are you wanting to dive right into the numbers and the statistics, or a lot of it seems like, how is this relationship? How is this founder as a person? Is it someone I like, right? Like, kind of a mentality, almost like a job interview.
It is. Even not a job interview, we really view it more as like just a collaborative process where we want the founder to feel comfortable with Album just as much as we want to be comfortable with the founder. So, we really spend a lot of time understanding, where that person's been, why they're doing this. So just to break it down into kind of a bite size, like we look at the why this person, why this product, or why this solution, why now. So it's kind of why this person, why this, why now. That's kind of the very germination of like our thesis is like, if we can answer those questions well, that's kind of how we get to a yes, is when that all kind of makes sense to us and hangs together. So it's like, if someone's coming, they've been working at Divvy, but they want to go build a medical device. Like that's just kind of where, they better have a pretty good story. But if they're like, you know what, I've been at Divvy, I was at Canopy, and one thing that I saw was that people don't have, employees should have a line of credit to exercise their options or something like that. Like I want to go build that. You know what I mean?
Something in the fintech world, because both of them were fintech, right? Like I would feel like you have that. Yeah, that makes sense.
Yeah. I mean, you don't have to be in the same market to build in that market, but it sure helps. And you should have some sort of a kind of the founding genesis insight. I think the best companies usually start from one of some story. So yeah, when we meet a founder, we don't jump into the numbers. Like, frankly, there's not a lot of numbers to jump into. We like to
because you're pretty early stage usually. Would you say majority are pre-rev?
About 25% is pre-rev. So they're not all pre-revenue. A lot of stuff has, kind of a very early beginnings of a customer base. Yeah. So yeah, we like to know the story of, why they're doing this and where they're headed, and so you really have to craft that story. We do too ourselves. I mean, we raise money ourselves here at Album, and, we have to craft the story to tell to our LPs, like why are we going to be out there finding the best deals when there's so many other places you could put your money? And, venture is traditionally and is a very risky asset class. So why invest in us? So stories are very important. You have to have a personal narrative and a founding narrative to whatever you're doing.
Well, and I think it kind of goes back to, it's like one of the big characteristics, or I imagine like big things you look for just in general, is vision, right? And I feel like that vision just comes from the experience or knowledge that they have around the problem they're solving, which comes from like their previous experience, as well as like the solution that they're building. So it's like, if you have past experience and you have a solid solution, you're able to basically craft like this master vision or this master story that typically will allow make people listen. And so to dive deeper into like that 25% that's pre-rev, pre-product, because those are the main people that are listening.
Yep.
What are some of the things, when you say like not customers, but basically like customers, what are some of those like metrics or things that they can have? Is it just email lists? Is it conversion data from like Facebook?
What replaces revenue, right? That impresses you, I guess, would be a good way.
I think knowing that they are in touch with their future customer base is important. That can happen in many forms. It can be pipeline, it can be wait lists, it can be an email list, it can be followers, it can be a lot of things, right? Just knowing that someone has an audience, or at least they know who their audience is, I think is really important. So some sort of a data point suggesting that, I think, is really important. We also see sometimes, early on when they're first developing a product, there's 2 or 3 people or customers that they've identified who have the problem they're solving. And there's a bit of a collaborative development process early on, or they have cobbled together something that is not scalable, but could serve that customer base. So they've kind of put together, it could be a spreadsheet macro, right? We don't see that a lot, but like, I'm just making up, like it could be something very, very simple where, look, this is what I'm going to be doing. It's not done very pretty, and it's not scalable, but they wanted it so bad that they were willing to use it. And they're actually paying me $300 a month for it. You know what I mean? Like, I just think signs of that can be helpful. I also think just customer conversations, get out of the building, go speak with 15 people that could be, customers in the future, and record some of those conversations or pull like some anecdotes out. Those types of things I think are helpful in a
validation, right?
Yeah.
Like of your customer.
And it usually comes through like if the founder has a sales bent, like if they're good at sales, like you can kind of tell. And that's helpful in a pre-revenue company, just to know, okay, when
they can sell
they do have a product, this person will be able to get out and make it happen and shake trees and kind of, close deals. So yeah, I think that's important. So if you're not that, I'm assuming a lot of your guests are not technical then, or you're not, a lot of these people are kind of coming to you to be your almost a quasi technical co-founder kind of person. So yeah, you better sharpen up your sales skills if you don't have the technical skills. Because I think those are kind of the 2 key skill sets at an early stage company are kind of sales and marketing and tech. So yeah.
And I think you nailed it on the head, because even like our favorite clients to work with are typically the ones who are ready to build, I want to say like V2. And the reason that I say that is because they've typically built a solution that like works. It just isn't scalable. Yeah. And the reason they're coming to us is because they want to make this thing that they put in place scalable. And just like you said, it's usually through spreadsheets or like, I don't know, 10,000 zaps all connected together between different sites.
Yeah, exactly.
This is like Band-Aids holding things together.
Yep.
Yeah, exactly. So I think that's super cool. And that resonates and makes a lot of sense.
So John, I feel like there's this black box, and you probably you're in this black box of actual fundraising. Yeah. And I think people just have no idea. And I want to really get kind of granular. So let's open this box and let's like jump in and let's talk about, let's say I'm a founder. Maybe I'm pre-rev, maybe I'm not, but I have a product that you're interested in.
Yeah.
Right. And we go to lunch and I tell you, we get along great. What is step 2 to step check in hand? Like, I just feel like people are just so lost right there.
They are. And there's good reason for that.
Because everybody probably does it different.
Everybody's got their own style, their own process. Yep. Early stage investing is a little more art than science. It's more like dating than job interview. You know what I mean? Like, I would say like private equity. Once you're more mature, that's more like applying for a job or a loan. It's very formulaic almost. And yes, there's a little bit of creativity, but it's like, do you meet these 8 or 3,000 check boxes? It's like, depending on the firm. For us, we don't have like necessarily check boxes per se. So I think a lot of people get frustrated because it's like, well, I know how to apply for school. There's these certain steps. I know how to apply for a job. I know how to apply for a loan. There's not really applying for early stage venture capital. There are accelerators and things like that are
not a ton though. Very few.
Yeah, there's very few. And the ones that you probably, the only ones you should go to are pretty hard to get into. So
like Y Combinator,
the other ones you shouldn't go to. So that's a personal opinion. Anyway, so I would say it's almost more like a dating process, like courtship, than it is anything else. And so there's a lot of intangible stuff going on here. There's a lot of like just need for EQ and reading the room and kind of understanding, kind of how to position and just how to follow up, how not to follow up. There's a lot of signaling effect. There's a lot of FOMO going on. So you got to understand, like us in this business, we have 10-year funds. So when we invest in your company, it's a 10-year fund. We are fully expecting this relationship could go on for 10 years. And so it's a lot more than just, hey, we met, cool idea. It could be the next Facebook. Okay, yes, we'll write a check. It's just, you kind of got to get to know the person and kind of see it in action a little bit for a few
So does
meetings.
that include weekly meetings with you guys, just going over like the vision,
Yeah,
the direction kind of?
it can be, but it's usually not as scheduled as that. It's usually like you got to understand like the first meeting is not to close the deal, and the pitch deck is not to close the deal, right? Your first meeting is to make an impression and to like plant that seed in their brain and hope that when they go to bed that night, they're thinking about your deal. And so when they wake up in the morning, they're like, I need to really spend a little time looking into that deal. They go and look around, they see something online, they see your blog post, and they're like, oh, yeah. It's almost like converting someone to a religion. You got to plant that seed somehow. It usually happens through, that first kind of narrative and like showing the dots, like I've been doing this and that's where it's going. And then, that seed sits and grows. And then you bring in more people and it's like the whole congregation gets converted at once. And it's like, oh yeah, the partnership's ready to go. We're super excited. We want to be in this with you for 10 years, and it happens over the course of, deals are happening quite quick right now, but honestly, like a lot of times we meet a founder and it takes 6 months to like kind of.
Yeah, I was going to say, how long do they open their seed round for? Is it usually
you
like
actually
6 to 8 months?
Yeah, you can run a process and like meet somebody and close a deal in a month, but it's harder. And I think it's riskier actually too, because just like we don't want to get into a deal with someone that we don't jive with or we can't help. They don't, the entrepreneur doesn't want to get into a deal with an investor they can't shed either, because it's harder to get your seed investor out than it is to get divorced, which is kind of crazy. And it can actually, in the long run, be more economically, hurtful too. So, I think founders should kind of approach it not as a transaction, but more as kind of like, I'm getting to know a lot of people. This is going to be a journey. So I don't care if it takes 2 months, 4 months, 6 months. I want to find the right people, right? So, and you're kind of building a religion. You get your mentors and your advisors, and you kind of like just building this kind of chorus around you that's out there saying good things about you. That's how you raise a good seed round. So, you sometimes see these seed rounds that are just insanely big. It's because these people have been building a following and a religion for years of themselves and their capabilities and what they're able to do and what they're able to sell. So it's not all that surprising when you kind of hear the backstory.
To go on to that, so let's say we date for 4 or 5 months. Things are going great. We feel comfortable, and you guys are like, cool, we do want to be an investor. Do you guys have cap tables that you have being brought in place? Do you have legal to come in before a check is actually cut? Like, do you feel like there's like a logistical side of it as well?
There is, yeah. So usually the cap table there's already a cap table with the company. Sometimes they have company counsel, oftentimes no, but usually they've formed at least an LLC. And it's like, okay, we have a business, and word to the wise, the new founders out there, make sure that with, usually co-founding teams, somebody involved in the early stages is going to depart. Like it's just going to happen. It's rare that like a founding team just clicks and they stay for 10 years. You need a vesting schedule in place, or at least some kind of arrangement that you don't leave a huge part of the equity and the cap table like going out the door on day 4 or I should probably say day 100 or something like that. 3 or 4 months down the road, someone will depart. So vesting schedules are your best friend. So they usually have an LLC. They come to us, we look at the cap table, and honestly, there have been times when we haven't invested because of the cap table for that very reason. When we look at it, we're like, well, I had this co-founder who was doing it for 6 months. He's gone. He owns 30% of the company. I own, 30. And then I gave, 30 to these 4 advisors. And you're like, wow, that's a bad cap table. You're the only one going to be working at it, and you're going to get diluted down to nothing over 4 rounds. And, these advisors are benefiting. So that's an important issue that I think people don't really think about. I think people know, but in the haste of getting it off the ground, they just kind of throw together a cap table. Anyway, so our process is, yes, usually we do a term sheet, and usually we've talked about most of the terms ahead of time. They're not all that surprising, and you can basically go look up the docs online. We use the NVCA standard docs, so you can go to nvca.org, I believe, and just look up, the basic financing docs. We do a stripped down version of those. So we buy preferred stock, and that's very standard. We sometimes do convertible notes or safes, but honestly, we're usually leading around, joining the board, and it's just better hygiene, we believe, to do a price round. It just, everybody knows what they got. There's no gotchas. You don't sit, when you kind of raise notes, sometimes there's that temptation, let's just keep doing notes. And then all of a sudden you're like, wow, those notes were very bad. Or you have this huge overhang that the next investor has to deal with. So anyway, so yeah, we use legal counsel. They help review the docs, they draft the docs. And usually the founders team has like their own counsel as well to kind of, just make sure everything's good and kosher. And then we close the deal. It usually takes, from term sheet to close, is probably 2 to 3 weeks, depending on kind of people's schedules and back and forth and all that kind of stuff. But 2 weeks,
still,
2 weeks
that seems relatively quick too. I'm super surprised, like, to hear that. This is super awesome.
Yeah. To get to a term sheet, I would say it usually takes about a month though. So 2 weeks to a month. So you're talking like if we've already kind of known you or we know the concept, and then 6 weeks passes, we're pretty much closed. So that's about it.
Cool. Sweet. So to kind of like paint the picture, typically it's like, somebody says, hey, let's go to lunch. There's like 6 months of like back and forth, communication, them giving you updates as they're like going through this process. You guys are finally like, hey, yeah, let's do this together, come up with some terms. That takes about 6 weeks, and then closed, signed, 2 to 3 weeks out.
Yeah.
I'm kind of curious, what does post-investment look like? So what are some of the things that you like to see post-investment? Is it just quarterly, updates with you? Is it more often than that?
Are you guys put on a board? Yeah, just those.
Yeah. So 75% of the time we do take a board seat, and that board seat is for a number of reasons, but most importantly, just to stay really well connected and involved. And I think that's been our most successful model, is when we have close proximity to the founding team. As far as frequency is concerned, it's usually dictated by the stage of the company. So if it's a very early stage company, it can be as frequent as monthly, or every other month. And these board meetings are not like you're imagining. This is not a bunch of suits sitting around a table voting on things. This is like a phone call, a Zoom, or sitting around a table for an hour and a half, talking about what's going on, what are the challenges, who are we hiring, that kind of stuff. It's more tactical than it is governance and kind of strategic. It's just kind of like, where are we headed and what do we need to get there? So, and then, so as they get mature, the traditional cadence is just quarterly. And those do turn a little more formal, where you have to issue, once you have 100 or 200 employees, you're having to issue options and things like that. Those are some of the housekeeping items that take place at a board meeting. But, we always tell our boards, like, the board is there to work for you. Send out your data and your numbers early. Let people review that on their own time. When they come to the board meeting, it's like, it's time you can ask questions, but then let's talk about the big challenges in the business. So that's what a board meeting looks like. But as far as our involvement going forward, post-investment, it's usually kind of threefold. Helping source talent. So, we do work here in Utah. We've sourced a lot of talent for our portfolio companies, and that's a big help. Second, just being decent people to work with and kind of doing the board stuff, like I mentioned. And then third, I would say, we have cultivated a lot of relationships with other investors that are going to write the bigger checks. And so thinking through your next fundraise and helping introduce you to people, it kind of helps shortcut the process and helps you curate a list of very good qualified investors that could lead your Series A or Series B or whatever. So I'd say those are kind of the three big things. And then, as far as intangible stuff, we just hope, we've built enough of a brand and enough of a portfolio that when you take money from us, it has a bit of a halo effect where, oh, that's an interesting company, so maybe I will join that company. Or, oh, Album is involved with that one. Okay, let's take that one a little bit more serious. So we hope that kind of is a nice halo effect for your company.
I think that's super interesting, and I'm just like, I love that we're like really getting into it. So I want to talk about dating, right? This process. Who's the aggressor usually? Who's the one that's like trying to set up the meetings or following up? Because I'm thinking of my dating years. Like,
Yeah.
I'll send a text to a girl and like, hey, what are you doing this Friday? Like, I'm kind of thinking like, are we? And I don't want to say the boys in the relationship. Is it the founders, or are you guys sometimes more like wanting to set up the follow ups? Who should take control in that situation?
It's both. So the more traditional aggressor is the founder. The founder is
which I would think money. So, right? They're trying to.
They have more incentives to be chasing us because they need money and they want money and they want Album to be involved or whoever else. So I would say 80% of the time that's probably the case. There are times when a deal, you start meeting with a deal and it's usually like instigated by the founder, but then it's like, oh, this is a really interesting deal. And then, we start really getting aggressive. So it actually kind of switches sometimes. So, or you hear of a deal through the grapevine that you didn't get introduced to, or that didn't try to seek you out. And it's like all hands on deck. We are going to go find that entrepreneur.
Who knows this founder, right?
We are searching our LinkedIn. We are texting everybody saying, please get me introduced to this founder. So that does happen. I would say that's only 20% of the time. Those have a very high conversion rate for getting money, as you might expect, because people are generally open to taking money. But sometimes the entrepreneurs that don't want money are the ones that, they didn't need money in the first place. So that's a
great sign.
Exactly. And it's like, that's the company I want, right? So, we at our stage, that's less common just because the companies basically need money, like software companies, best business model on earth ever. But they go through a J curve, right? They go through this part where you have to build, and then, sell. And then you might, become, this awesome machine with high gross margins. But, where we're playing, it's like this. But then the growth stage, that's where it gets, I would say those growth firms are very aggressive. That's why they have an army of 100 people scouring the world trying to find companies. So they're very aggressive.
So to go along with that question, because I had girls tell me no all the time. My wife told me no 3 or 4 times. She wasn't interested, but I was persistent. What type of advice? So sometimes people aren't ready for fundraising. Yeah. What type of advice would you give for those people to maybe not so much take no for an answer, but like, hey, not right now? How should they stay in contact?
I think an underappreciated tool in the entrepreneur's toolbox is kind of the update letter. Some entrepreneurs do it well, some don't. But like I said, I think it's smart to get mentors and advisors. You don't have to necessarily give these people shares even. Or if you do, like they should have a vesting schedule. But like a lot of great startups have mentors and advisors and you've got friends. And it's like, get those people first. Add them to an email list. And every month say, what's been going on? We've talked with these 8 customers. We're doing this on the product. We're bringing this person on the team. Like that kind of stuff. Kind of showing it's a very scalable way to keep a lot of people updated. And, some entrepreneurs, it seems like especially kind of the first time entrepreneurs are real cagey about their ideas. Honestly, nobody cares. Nobody cares. Like you've heard it before, but ideas are a dime a dozen. It's the execution. It's absolutely true. 100%. Like nobody's going to steal your idea because guess what? They're going to have to go work for 10 years to make it work too. So like there's no silver bullet. Look, have some discretion if like it's some company that is very, very close, but like for the most part, nobody wants to build your startup.
Austin has a smirk right now because you have no idea how many times clients are like, I need you to sign an NDA before we even talk to you, and be like, listen, bro, we've had this same idea pitched 6 times to us. Not one of them has executed it yet. Yeah. That's really what your secret sauce is. Trust me.
Yeah, exactly.
Well, and it's so funny because we're actually giving a speech at Denver Startup Week tomorrow. And that's one of the things that we talk about is the fact that like your idea is not going to make it because you were secretive about it. Yeah. It's going to make it because you're damn good at executing, basically.
Yes, exactly.
So I think that little piece of advice, John, that you had just given, that's not a hard thing to do, right? Is putting together a list of newsletters. Like that doesn't cost you any money. You're doing the work anyways.
Yes. So I would also say,
do it.
Yeah. I've kind of referenced religion a few times. I would honestly encourage most founders, treat it like a religion. You are building a religion. If you're building a religion, you're not keeping a secret. You want to tell people. There's a reason the Mormon church has grown fast, not to get religious, but we are here in Utah. It's like they're out in the world telling everybody. They're not keeping it a secret. If Joseph Smith would have never told anybody, like the Mormon religion would be dead. So will your startup. So it's like the risk is the bigger risk is not telling people, honestly. You want to get a chorus of people around you that are just like cheering for you. And it's like they introduce you to customers and things like that. And always have an ask. It's like, here's our asks. Do you know any designers? Do you know any customers that fit this profile? Do you know any, you know what I mean? Like you got to ask. You got to have like the story, the pitch, and then the ask. You always have to have it.
And you know, how much do each of those cost? Nothing.
Yeah.
Right. That's huge. You don't need capital, because I feel like people will just use that as an excuse. Like, oh, I'm just waiting for a round of funding, or I can't get my idea off the ground because I can't. Like, those things are free that you can do as a listener who's listening right now. Yeah. Driving your car, whatever it is, like start doing those things because they don't cost anything. And that shows like you're getting the traction. And so I think that's such a huge piece of advice. Really, really well said. John, in closing, I'm curious, as somebody who's been in this industry and who's seen success and failures and things, what kind of closing piece of advice do you give to our listeners as we finish?
So knowing the audience is a lot of people starting, likely for the first or second, maybe third time. But, you know, I see a lot of people kind of feeling like it's super risky to start a startup. And, you know, in some ways it is. Everyone's got different personal circumstances. It is harder for a person that has massive mortgage and super high obligations to start one rather than like someone that has nothing. But I would say the bigger risk is honestly just not starting. The bigger risk is getting to your deathbed at 90 and saying, I wish I would have. I wish I would have tried. I should have. You know, I could have. Because honestly, this is not rocket science. Anybody can start a company, and we happen to live in the most prosperous time ever in the history of this world. You know, there's more resources than ever. You can Google stuff. There's Stack Overflow. There is forums. You can basically learn anything. And so the only thing holding most people back is honestly the effort and the try. So I know that's easy to say, hard to do, but it's like, what's the rush? You know, we're all sitting here on this planet anyway. It's like, who know? We don't know when we're going to die, but we know we will. And so might as well do something interesting with your time, you know, in the meantime. So if you really want to start something, I think you will. And I hope you do.
That's awesome. John, thank you so much for being on the show. Really just some nuggets of advice. Your guys' website is album.vc, correct?
That's it. That's cool. Right. Yes.
So yeah, if you guys want to learn more, we'll throw that in the show notes.
Great.
John, are you on LinkedIn, Twitter?
You know, I'm on LinkedIn. I'm not real active, not too active on Twitter, but I do have a Twitter profile. I can send it to you.
Cool. Yeah, just so our listeners can kind of.
Yeah, I'm more of a consumer. That's where I get my news. I don't really engage too much on there.
Me too.
I do engage on LinkedIn a little bit. So LinkedIn's where
my Twitter feed is just college football. That's all it is.
Yeah.
So cool. Well, thank you so much for joining, and we'll add all that to the show notes.
That sounds great.